Building wealth and achieving financial freedom is something the vast majority of us strive for. In this endeavor, who better to take advice from than a man considered to be the most successful investor of the 20th century? Warren Buffett has amassed a net worth of over $108 billion by defying prevailing investment trends and relying on his own sound judgment. Today, we'll be bringing you inside the mind of the greatest investor of our time as we look at some of his most important pieces of advice, sure to level up your investing prowess and give you a clear advantage to other investors in the market. These are 7 things to avoid at all costs, told by Warren Buffett. And number 2 is a real game changer for many retail investors today. Number 7. Having a short-term investing focus. Making investment decisions based on a short-term time horizon is a huge mistake in Buffett's book. He is well known for his buy-and-hold ideals, holding many of his investments for decades. He's even been quoted saying, "If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes." This mentality has helped him amass over 900 million shares of Apple and over 1 billion shares of Bank of America. Rather than selling shares of these companies and taking profits when they perform well, he holds firm to his strategy for the long haul. This is evidenced by his quote, "Our favorite holding period is forever." Phil Fisher, considered to be a pioneer of growth investing and one of the first adopters of the buy-and-hold method of investing, once wrote, "It is only occasionally that there is any reason for selling at all. If the job has been done when a common stock is purchased, the time to sell is almost never." Warren Buffett strictly follows this philosophy and advises that when you buy a stock, you should do so with the intent to hold it forever. This doesn't mean that you should purchase shares from random companies and keep them forever, no matter what. Instead, you should do your research and only invest with a long-term mindset. Therefore, this method ensures that you become more selective with your investments. Number 6. Failing to understand the difference between price and value. As the saying goes, some people know the price of everything, but the value of nothing. According to Phil Fisher, the stock market is filled with these types of investors. Buffett believes that it is critically important for investors to be able to distinguish between price and value in order to sift through the noise and make sound decisions. Just because a company's stock price hasn't changed doesn't mean that their fundamentals have changed. Price is what you pay. Value is what you get. Warren Buffett's belief is that if a company is good, the share price will eventually follow, and vice versa. If you take a look through his trading history, you'll find evidence of this truth. Number 5. Following the crowd. Being a contrarian has its benefits. Mr. Buffett explained that one of the great advantages he has over most investors is that he doesn't care what other people are doing. He understands that humans get fearful when others are fearful, and they get greedy when others are greedy. Blindly following the herd is a bad idea for many reasons, including the fact that it generally isn't all that profitable to do so. Great investors understand that if a certain company's stock soars and is suddenly the talk of the Wall Street, the media, and the public, the best time to invest in that company has already passed. At least in terms of participating in the spike. If it's already news, you likely missed the wave and are only setting yourself up to be disappointed when the hype dies down and the stock price falls. Similarly, when the overall market is declining due to large-scale sell-offs, it probably isn't the best time to sell out of your positions. By this time, the value of your positions has decreased significantly. Excellent investors like Warren Buffett use the pulse of the market to their advantage, buying companies they like when they're on sale, taking advantage of the mistake of others. As we discussed in our previous videos, this is how the rich get richer. Number 4. Diversifying too much. Diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited. As far as the stock market is concerned, you can mitigate risk by investing in multiple companies in multiple sectors. It's never a good idea to have all your eggs in one basket, right? While diversification is necessary and recommended, Buffett notes that there is a limit. We simply can't find 100 different securities that conform to our investment requirements, he says. However, we feel quite comfortable concentrating our holdings in the much smaller number that we do identify as attractive. In 1960, Buffett's largest holding was 35% of his portfolio. Today, Apple stock takes up a similar portion of his total equities portfolio. This is in stark contrast to the many mutual funds today with hundreds or thousands of stocks in their portfolio. He's comfortable investing in this manner because he invests with conviction and he uses specific criteria when adding positions. In order to hold these companies for the long term, it's crucial to invest in companies with favorable long-term economic characteristics and competent management in an industry you're familiar with. Don't over-diversify your portfolio because you are ignorant or fearful. In doing so, you'd likely end up owning loads of mediocre businesses, and it would be nearly impossible to keep tabs on current events impacting each of them. Number 3. Timing the market. The common aspirations of investors, or even people, worldwide is to buy low and sell high. While this is a good principle, some can become obsessive about trying to predict the future direction of the stock market and take action based on their assumptions. Warren Buffett doesn't practice this at all. In fact, he doesn't worry about market timing much at all. I know of no one who's been successful and made a lot of money predicting the actions of the market itself, he says. But I know a lot of people who have done well picking businesses. He further adds that he hasn't the faintest idea what the stock market is going to do on any given day. Instead, he deeply researches companies and holds on to the best ones for long periods of time rather than riding market waves. Number 2. Taking too much action. Analysis paralysis is real. This is when an individual overanalyzes a scenario to the point that they can become paralyzed with fear or uncertainty, leaving them unable to decide on a proper course of action. Taking action is absolutely necessary. However, staying active all the time can be extremely detrimental to your financial health. Taking too many actions, such as buying and selling frequently, can lead to overtrading, which can increase transaction costs, such as brokerage fees and taxes, and eat into investment returns. Overtrading has become more of an issue recently as investors are leaning on their emotions instead of research when making decisions. This causes them to miss out on long-term investment opportunities as they sell holdings that would have generated significant returns. Number 1. Investing in assets you don't understand. This mistake is easily the most critical of the bunch. Thankfully, it's also the easiest mistake to avoid. The concept is simple. Warren Buffett advises to never invest in a business you cannot understand. This can be risky for many reasons. For one, if you invest in stocks that you don't understand, you may not be able to assess their risk level or potential for returns accurately. It will also be difficult to tell if information about an investment is accurate or if it's being presented in a way that's meant to be misleading. This can obviously lead to bad decisions and potential financial losses. When you don't understand an investment, you're more prone to make decisions based on emotions instead of logic. This can result in impulsive investments or panic selling, both of which are discouraged. This has become much more prevalent in modern investing, especially with the rising popularity of cryptocurrencies and Web 3.0. Many people invest in crypto assets with no foundation of knowledge on the use and potential of the assets. They buy them simply because others are talking about them. Without having a thorough understanding of the assets they purchase, thousands of investors have seen their portfolios decline. Don't follow their mistakes. Famed investor Peter Lynch once said, "Never invest in an idea you can't illustrate with a crayon." As simple as it sounds, if you're unable to gain a reasonable understanding of how a company makes money and the main drivers that impact its industry within a short period of time, it's best to move on. If these words of advice helped you in any way and you plan to implement some of these moving forward, put a $sign in the comments. Also, let us know which of these mistakes struck a chord with you the most. Thanks for watching, and we'll see you in the next video.